market and a bear market at the same time. We've never seen, basically within a 1 month period, we've never seen $2.8 trillion of fiscal stimulus happen all at once. We've never seen the tax law get turned over, the SBA law get turned over, and the Fed start buying, 20-year bonds off in the open market. It's just a crazy time, and we hope you're all safe, and we hope you're all doing well. I've got an esteemed panel with me today. I'm going to ask each of them to introduce themselves. I'm joined by Gary Rose, who's an attorney also of Blue Sea Advisors, joined by Mike Lorenz, the tax partner for Cohen and Company, CPA JD like myself, and Bob Wines, JD CPA. I guess depends on which hat you're wearing at the time. If you're both, if you're wearing the CPA hat, you go CPA first. Gary, you want to give us a little brief introduction about you and what you do at Blue Sea?
Sure, thank you. I'm a fellow attorney and practiced law for about 8.5 years, then became general counsel and vice president of finance for a family-held business. Helped grow that into a middle market size manufacturer. Since then, I've gotten licenses in real estate and business brokerage, life and health, consular licenses. And I founded Blue Sea Advisors Network, which is a group of about 65 plus professionals that serve the middle market business owner.
That's great. Mike, you're my tax whiz. You want to introduce yourself?
Certainly. Thanks, Leon. You are right. Like the rest of the panel, we seem to have a lot of attorneys and CPAs. I focus primarily on tax at Cohen and Company. Cohen and Company is a regional CPA firm. We have about 600 folks from Milwaukee to Baltimore. We're a full service firm. We do accounting and auditing work, tax work, and buy-side, sell-side consulting. I'm primarily in the tax department and working on a lot of the issues with the CARES Act.
And I'll be asking you some questions about that as we go. By way of introduction, I'm Leon Lebrecq. I'm also an attorney at CPA. I'm the Chief Growth Officer of Sequoia Financial Group. And I work with these smart folks and a variety of other smart folks on a lot of these things. I've been heading up the MICPA Special Task Force on the PPP and also on the CARES Act. I also am like the resident nerd, so I sit around reading all this stuff. Speaking of resident nerds, I'm going to introduce my very good friend and someone who co-worked with me at Plant Moran 35 years ago, Bob Wines. Bob is an attorney and CPA. Bob, why don't you give a brief introduction, then why don't you start telling us about the nuances of PPP, like whether we're ever going to get it, whether we have to pay it back, and whether we can pay it back. So I'm going to flip it over to my buddy, Bob. Thank you.
Okay, thanks, Leon. Yeah, my background, I did startups for years, and then I was in private equity. And then in the last 7 or 8 years, when I retired from private equity, I've been involved with consulting. And but I think probably the most interesting thing, there's no better way to kind of end the day than talking about PPP loan forgiveness. I mean, what better thing to do? So I would say, why don't you grab your favorite COVID cocktail? You're going to need it. And then I would say, sit back in your Barco lounger and kind of let's get started. So I'm going to share my screen if we can
grab a quarantini, I guess.
Yeah, everyone.
I like a quarantini. Yes.
At the bottom of your screen, you'll see there's a chat function. If you click on that, it'll open chat to the right of your screen. And you look at the bottom, there's the ability to ask questions through the chat function as we're having you all muted right now. And then we'll start getting to the questions after Bob is done. I'm going to send out an introduction through chat, so it should pop open for everybody right now.
And you'll beg for me to be done quickly.
Yeah, I like the Corona coffee. It's coffee with a margarita in it without any coffee.
Oh, I like it. I like it. Very tasty. Very tasty. Okay, can you see my screen? Let me know, Leanne. Is that visible?
Mm-hmm. You're good, Bob.
Okay, perfect. Just broad overview, there's around 13 different packages between the CARES Act, the FFCRA, and state provisions. Today, we're going to focus really just on the Paycheck Protection Program right here. We'll hit very quickly the EIDL loans and the EIG grants. At a later webinar, it probably makes sense for us to talk about the Employee Retention Tax Credit and the ability to delay employment tax payments. If you participate in those programs, you can't be in the Paycheck Protection Program, so let's focus on the Paycheck Protection Program today. First thing we're going to talk about is managing the PPP loan forgiveness provisions, and then later we'll talk about the documentation we need to have to make sure that the amount that we think we're going to have forgiven is actually forgiven. Quick overview, just a refresher on the PPP. The goals were to keep small businesses alive maintain employment. The 8-week period was selected because, to be honest, Congress, when this whole thing started, thought, oh, 8 weeks, that should be enough to get through a pandemic. No one knew. What is the PPP program? If you remember, you take your monthly average payroll, you multiply that by 2.5. That gives you the maximum amount of loan you can get. When you get your loan, you've got 8 weeks to spend it from the day the funds are deposited in your account. They call that the covered period. The unique attribute of the PPP program is that the loan is partially forgivable. So what costs can be forgiven? Obviously the payroll costs, that's the core. We can, if we spend the PPP funds for payroll, those costs can be forgiven. And there's certain non-payroll expenses that can be. Rent and lease payments can, utilities can. We'll go through the details as to which utilities. Mortgage interest and also apparently secured personal loans, but it's only the interest portion of those. It's not the principal portions. The key to remember is that these costs, according to the Act, must be incurred and paid within 8 weeks of receiving the loan. That 8-week period is what we call the covered period. The other thing to remember is that these non-payroll expenses, the rent, lease, utilities, et cetera, those cannot be more than 25% of the total amount to be forgiven. Quick and easy way to do a check on that, just see what your payroll costs are that you think are forgiven, divide that by 3, that'll be 25%, and that's the cap you're gonna have for non-payroll. So if your payroll costs are 30K, you could say, oh, divide 30 by 10 or by 30 by 3, I've got 10,000. The most I can take as be forgiven out of my non-payroll expenses would be $10,000.
Hey, Bob.
Yes.
Quick question. Somebody asked, will the slides be made available? And I'm presuming the answer to that is yes.
Yes. In fact, I would like, however I can publish these, if I can just give them to MICP and they can distribute it, that would be great. Yeah.
Yeah, I think we can do it that way. And then Jim asked us, is the deposit date of the funds in the account, is that the beginning of the 8-week period?
It is. It's the date that they're dispersed to your account. Yes. So the date you get access to them.
Okay, that's what I thought. I just wanted to make sure we verified that. Thank you.
You're welcome. Okay, let's think about the congressional intent for the loan forgiveness. The goals were, don't do any layoffs, don't do any pay cuts. If you don't do those two, keep all your employees fully employed, keep them all at their current salaries, there would be no loan forgiveness, reductions in your loan forgiveness. It was a great idea. It doesn't work quite as well as planned. We'll go through why. First of all, let's talk about layoffs. If we lay off people, that's going to reduce the percentage of our PPP loan that can be forgiven. So if I've got 10 people in my company and I lay off 4 of them, then you know what? I've only got 60% of my people there. So I'm going to reduce my PPP forgiveness by 40%. So I get a 60% forgiveness percentage. We'll go through that calculation. However, and this is very, very important, if you have a layoff between February 15th and April 26th, and you rehire that person at full pay, or you replace that person before June 30th, you can pretend the layoff never occurred. So the key is it's got to be within those time parameters. If you lay off someone today and then rehire someone or rehire them or bring someone back as to replace that position, it's not going to qualify because they weren't off between 15th and April 26th. Okay, big picture on this for the how you do the calculation is there's 2 parts of it. We have to look at our historical employment levels. They call that a base period. We're going to have a choice of 2 historical periods. We'll go through that. And again, it's what we talked about. If we pretend historically we had 10 full-time employees, and today we've laid off 4, so we only have 6 left over, just like we talked about, 6 divided by 10, 60%. Our forgiveness percentage is 60%, which means if we had a $100,000 PPP loan and we spent it all for things that should be forgivable, they would say, oh, very good. Yep, there's 100,000, but because you laid off 40% of your people, we're only going to forgive 60%, allow forgiveness of 60% of the loan, okay? How do we calculate the forgiveness percentage? You take your average FTEs, full-time equivalents, per month in the covered period, which again is that 8-week period, which starts with the day the funds were dispersed to your account. So we're going to pretend that they were dispersed on May 1st. So between May 1st and then the 8 weeks would end on June 25th. That's our covered period. We calculate the average FTEs for the covered period. We divide that by the average FTEs for our base period. Excuse me. Our base period, we have a choice. We can pick February 15th through June 30th of 2019, or we can pick January 1st through February 29th of 2020. We calculate the average FTEs. What you do is you look at each pay period, you calculate an FTE for the pay period, then you average the pay that fall within the month, and that gives you your average covered periods and average for the base periods. It sounds like a lot of gobbledygook. Let's go through an example.
Hey, Bob.
Yes.
I just wanted to tell everybody, Jamie Lopiccolo, another director from the MICPA, is on. He's going to help answer some of the questions because we're getting a ton. So
good.
Questions like, you know, is rent paid if I started the period on April 15th and I paid my rent on the 20th, can I count that rent? And the answer is yes. But I think one of the questions out there is, it is going to be cash basis? Is it going to be imputed? So I'm sure you're going to get into that. But I just wanted to thank Jamie Lopiccolo. He's on the line. Great CPA and also helping us out here. So.
And Jamie and I have been talking back and forth. He is a phenomenal resource. Actually, he's been a great mentor to me. So yeah, this will be great. It'll be great.
And he's a really good beard too.
Yeah, he does. He does.
He's a COVID beard.
A COVID period. I like that. I like that.
Go ahead, Bob.
Period.
I'm sorry.
It's the 8-week period. So let's assume we got our loan on May 1st. So we'd say, okay, we would look at it. And for May, we had 5 employees full-time. We had 5 employees who were half-time. At this point in time, we would say that we've got 7.5 full-time equivalents for May. For June, we laid off 1 full-time, so we're 4. We laid off 1 half-time, so we're 4. So for June, our full-time equivalents are 6. We then take the 7.5 and the 6. We average those. We say, oh, our base period our covered period FTEs is 6.75. Now we've got to figure out what's the base period. Well, we've got 2 base periods. We got February 15th through June 30th and January 1 through February 29th. This phantom company had 5 full-time employees for the first February 15th, and it had 4 half-times. So we had 7 for the first base period. The second base period, we had 5 and 5, so we had 7.5. What we want to do is select the lower of the 2. So we want to select the 7. And what we do next then is we do a quick calculation. We simply take the covered period FTEs, which is a 6.75. We take the base period FTEs, which is a 7.0, and we divide the 2 and we come up with a forgiveness percentage of 96, which simply means this. If we have a $10,000 PPP loan and it's all potentially forgivable because we've used it for qualified costs, and the only thing we did that would cause a reduction is this minor reduction in FTEs, they'd say, you know what? You can keep 96% of it as forgivable, so 9,600 is forgiven, 400 isn't. Now, the second part, remember the congressional intent says no layoffs, which we just went through, that's our FTEs. They also said we don't want you to have pay cuts. So let's go through the pay cuts. Basically saying that if we generate pay cuts, they're going to take a portion of those pay cuts and reduce the amount of loan that can be forgiven. How much? If the pay cuts, any pay cuts that exceed 25% of an employee's comp, we got to take the excess above 25% and say that's a reduction, a subtraction for the amount that can be forgiven. There is a big exception to this rule. In fact, there's 2. The first one is that it doesn't apply to employees who make more than $100,000. What they say is you look at 2019, if any employee made more than $100,000, you can cut his or her pay as much as you want. Why? They're thinking these people are very well compensated. They might well be owners. They're going to need to take pay cuts. They're probably going to take pay cuts way in excess of 25% because they need it for working capital and to protect other people's jobs. So go ahead, cut their pay all you want. There's a weird aspect to the way they do the calculations though. They say that you have to, and I can't believe they're actually going to put this through in the final rules, but this is what the act says, is that you have to look at you have to annualize every individual pay period. And if any individual pay period is annualized, comes up to be more than $100,000, that they're treated as being in excess of $100,000, we can cut their pay as much as they want. So let's give a quick example. I make $75,000, let's assume. But let's assume during the year, I'm given a bonus for one pay period. That bonus plus my normal comp, if I annualize it, suddenly puts me over $100,000. Well, if we follow the act, you can cut my pay as much as you want and it would not impact the loan forgiveness dollars. Does it make sense? No. Will it be corrected by the SBA or in final rules? I'm assuming it will. We'll have to see. Let's go through a quick example of how the loan or the pay cuts work. So we've got 4 employees in our phantom company. And here we've got Jane Yashimoto. She in Q1, you look at Q1's compensation. You look at the cash compensation. And I'm going to call it normalized cash. I'll explain in a second why. Her normalized cash compensation was $13,800, which means we could cut her pay by 25%, bring her down to $10,400. If we did, there would be absolutely no reduction in our forgiveness. But we kept her pay at normal, so forgiveness reduction, 0. Ahmed, on the other hand, he's at $12,300. We could cut him down to $9,200 with no harm, but we cut Ahmed down to $6,200. Therefore, our loan forgiveness is going to be reduced by $3,000. We've got John Sinclair, very popular in Ann Arbor in the 60s. Whoops. We could cut him down to $9,200 also, but we cut him to $5,000. So we should have a $4,200 reduction in the amount of our loan that can be forgiven, but we're not. Why aren't we? Because if we eliminate the pay cut to John before June 30th, it will be fully restored. They will pretend as if there was no pay cut. Now, there's a caveat. Just like with the layoffs, the pay cut must have occurred between February 15th and April 26th, and we have to restore it before June 30th to the February levels. We're going to pretend that happened. So even though John has a nice big pay cut because we restored it by June 30th, no harm, no foul to us.
Hey, Bob.
My favorite person, yes, go ahead.
If we paid John a retention bonus, would that be the equivalent of eliminating the pay cut? So if we offered John money to come back?
If it's part of his whole compensation, yeah, I don't see any reason why.
So we could, if John was laid off for a while or whatever else, I wanted to bring him back, as long as I brought him back and paid him with a retention bonus or something like that, would that work?
Well, they're not even trying to make up the old amounts. Let's assume John beforehand was making, $4,000 a month. If that's it, and we cut him down to $2,000 a month, and then on June 15th, we said, you know what, you're back to your $4,000 a month salary. We don't have to make up the old stuff. We just have to bring the pay level back to the old rate, to the February 15th rate.
So you just got to bring the pay level back. Okay, that's
just
important.
Bring the pay level back.
I think a lot of people are confused about that.
Yeah.
Okay.
Oh, I hope I can confuse them more. Ebenezer Scrooge, my favorite person of all time. He, on the other hand, we look at him and we go, oh, gosh, we brought him, he was making 20. We could cut him to 15. We cut him to 10. We should have a $5,000 reduction in our forgiveness, but we're not. Why? Because he made more than $100,000 in 2019, so we can cut his pay all that we want. So if we look at these things, we have all these large pay cuts that we've got, but the only impact is $3,000 on our forgiveness reduction, because that's just Ahmad. That's the only one that impacted us.
So Bob and Mike, question that came up is about 401k. So what about 401k match? We know that goes into payroll. So a 401k match does go into payroll. But what if the plan document says you can't put the match in until the end of the next plan year? Can you accrue it, or does it have to actually be paid? Either one of you can take that. Mike, do you know the answer to that one? Or
I can tell you how I read the rule. The way I read the rule is it has to be paid. Now, I haven't seen a plan document that doesn't allow you to make a contribution like that, but I suspect they're out there. So my rule, what I'm working with temporarily until we get much better guidance, and I'm sure we'll talk about that in a minute, but I read the statute to say accrued and paid. So where possible, I'm recommending to clients to actually pay the 3 or 4%, whatever it is, on the wages during that 8 weeks.
during the 8 weeks? Bob, what do you think? Same thing?
I agree. Right now, if you look at the rules, they're and paid, so it'd have to be for that time period and paid before the end of your 8-week period. I expect that they will do something in the rules to be a little more lenient on it, but right now we don't know, so you better plan on it. You better plan it's paid, it's incurred and paid.
We had another one that I think got answered last night by the Treasury. Omar asked, can you substitute a new employee for a previous one and avoid reduction? So if John took off and left for the woods, you know, and went off to write his memoirs, could we replace him with Upton Sinclair?
You can. You can.
I think that question, actually last night, question 40 did better than that.
Yeah, it did, didn't it? Yeah.
They took the, not only did they, because you're really talking about the numerator of the fraction, question 40 really says you can take them out of the denominator.
Right. Because if they left and didn't come back, then
they don't count at all.
It's one
and
better, isn't it? Yeah.
Right. You're actually better if you hire a replacement.
We did have a couple of questions, by the way, and just wanted to clarify. I can clarify MUD because there's no information on this. Quite a few people are asking if we're on a shutdown order, does the 8-week period get extended? Right now, no. But the AICPA has been lobbying Congress. The MICPA, I know, is writing a letter on behalf of its members to Congress. I have had communication with several U.S. House of Representative people, from both the head of financial services to Ways and Means. All of them are aware of it, and that's an important point. Jamie was bringing up a question on number 40. Question number 40, Mike. That's if they refuse to come back. That's what question 40 covers.
Right.
I think obviously if in our case, if John left and Upton, and we didn't try to call John back, but Upton came in, then we would still have we'd have the eligible for the forgiveness. If we offered John the job back and he rejected it, we could take him out of the numerator and the denominator.
I think that's right.
Yeah. Okay. Great. Sorry, Bob. Keep going. But
No
we got
problem.
a million people are really interested in this, so I'm going to try to keep us going on this.
Okay, good. One nuance, if you look at it, the Act actually says that you're supposed to compare the current wages during the covered period, the 8-week period. And if that is less than the wages in Q1, you've got a reduction. Well, let's think about that. That makes absolutely no sense. Q1 has 13 weeks in it. Your covered period has 8 weeks. That would mean to avoid a payroll reduction, you would have to give every one of your employees a 64% pay increase. So I think we're going to find that they're going to come to a conclusion that, oops, we didn't mean that you had to actually have it be the same as your Q1 payroll. It's the normalized payroll. So you take your 13 weeks, you would look at that, and so you take the Q1, you divide it by 13, multiply by 8, and say, oh, yep, that was my normalized cash wages in Q1. That is not in the Act. I've got that in here for my example because I can't imagine they're going to do anything else, but hey, they've done other things that I couldn't imagine.
We are getting a question on 401k match, not increasing compensation in the forgiveness part. I was under the impression it was. Can Mike or Bob, can you clarify that, please?
Restate the question.
Does
Yeah, I'm not sure.
The statement is 401k match does not increase compensation and thus forgiveness. I thought it was part of the compensation package.
It is part of your compensation package. It doesn't count as part of your $100,000 test. Your $100,000 test is looking at cash compensation. It's not looking at healthcare costs. It doesn't look at retirement costs.
So if I have an employee that's making 100,000, just 100,000, and I do a 3% match, I can count the 3% plus the 100%. Is that correct?
Yes, you can.
Okay.
Yep.
You agree, Mike?
That's my understanding.
Okay.
I will tell you this.
There's an FAQ on it.
Everything we're working on right now, I think there's going to be more guidance. There needs to be more guidance, but that is my read as well.
We have a question from an old friend of mine. Does Q&A 40 apply to an employee who died from COVID or for any other reason? What if an employee dies and can't come back? Are they out of the denominator and the numerator, or are they still part of the FTE calculation? I mean, it's a weird question, but it's a good question. I mean, it's something they didn't think about when they sent the stimulus payment either. No, none of us have thought of this, have we?
The 41 actually, FAQ 40 addresses that because the person refuses to come back. If the person dies, they obviously cannot come back, so they'd be under FAQ 40.
Jamie said he thinks a death certificate constitutes document of refusal.
I would think that would probably do it. Yeah, I would think even the most rigorous bank auditor would accept that. Yeah.
I think I would agree. We don't know the answer to that, but I think our consensus is death would take you out of the denominator and the numerator.
Okay. Let's go through just a quick calculation. The concept is this: we're going to pretend the company had a $50,000 loan. What we're going to look at is how we calculate the total forgivable payroll costs, how we calculate the total forgivable non-payroll costs, and then how the forgiveness percentage applies. Here's the details that we're going to go into. So we're going to have basically $38,500 of total payroll costs. I'll go into more detail in a second. We're going to have $10,100 worth of non-payroll forgivable costs. Let's just look at the payroll costs themselves. So here's our $50,000 loan. Our company's got $35,000 worth of salaries and wages. They don't have any parental leave, vacation leave dismissal, or if they do, it's been rolled into the salary number. They don't have any health care, but they do pay workers' comp, so we throw in a little bit of workers' comp that applied to that. Whoops, I keep hitting this little thing. Then on top of it, we've got retirement benefits, and here's where we'd say, okay, if there's like a 4% match, well, the 4% of the 35K would be $1,400. And then they've got unemployment insurance. So we add all those together, and we're at $38,500 worth of covered period payroll costs. So these could all qualify for forgiveness. However, there's some subtractions. Did any of our employees have cash compensation in excess of $100,000 for the 12-month period? We're going to say no. So there's no reductions for that. In our $35,000, were any of those people non-residents of the U.S.? No, they all lived in the U.S., so there's no reductions for that. This is the weird one. This one, it's actually in the act. I couldn't believe I read it, but it basically says that you have to subtract from the qualifying payroll costs the employee's federal withholding and the employee's portion of FICA. Now, that doesn't make any sense because it's part of the gross wages, but it's in the FAQs. They skirted it for the loan amount, but they didn't skirt it for purposes of forgiveness. So in our scenario, we're going to pretend they had $6,900 worth of employee withholding and employee FICA. We'd have to subtract that from our $38,500. And then down here, we've got the payroll reduction. If you remember here, we had $3,000 because of Ahmed, because of the pay cuts we gave him. Well, because of that, we got to take the $3,000 off of here. So we paid $38,500. We got to take off $9,900. So $28,600 of our payroll costs would be forgivable. Now we want to look at our non-payroll costs that are forgivable. Well, rents are non-forgivable, but like we talked about earlier, they've got to be incurred and paid in our 8-week period.
Hey, Bob, can I jump back in on the comp for a second? Can you go up to the slide just for a sec?
Sure.
We have a great question from Wendy. I just want to make sure we clarify it. On the payroll taxes,
Yes.
you've got on there employee withholding and FICA. What about Medicare tax? Is that part of it too, or is it just FICA?
FICA's the grouping of the Social Security and Medicare.
Okay, so you're putting the 7.65% in.
Exactly.
Okay, I just wanted to make sure we clarified that because you wrote FICA and I thought you meant both, but you did mean both.
You know, and I even looked at before I put FICA in there because I looked at the definition. I may have gotten a bad definition. I thought when it said FICA was included the Social Security and the Medicare tax. So if it doesn't, I meant both. So.
Yeah, I think it technically is OASDI or something like that. Hey, Mike, a question for you. On worker comp, if they prepaid their workers' comp, can they add 8 weeks of premiums or has it got to be paid?
It depends on how literally you read it. I'm reading it literally that it has to be paid during that period. Now, the one area where I'm I'm actually reading question and answer on the payroll costs. I think it's question 16 in the FAQ.
Yep.
I'm a little more liberal in my read on that. So I think it's reasonable to assume, but I don't know this, that the same definition should apply for the base period as the forgiveness period. But I think this is certainly a reasonable possibility, but I don't understand why the government would have two different definitions yet.
I just put up the FAQs too, by the way. So everybody's talking about the FAQs. I just put the link to the FAQs on our chat. So if you are trying to figure out what we keep talking about on question 40 and question 49 and speaking in COVID code.
And this one happens to be question 16 and the footnotes under question 16,
yeah,
which I think everybody should really be interested in. But it's a big dollar item, so I think you have to look at it.
So,
Yeah,
so
and
Bob,
actually, I think if you look
question.
at it, you'll find that that is true because that's talking about the loan amount, the maximum
Right.
loan amount. There's a separate FAQ which addresses the forgiveness amount, and in there they basically say you got to subtract it off.
Which
So I'm
FAQ is
not-
that? Which FAQ is that, Bob?
I don't remember off the top of my
Okay.
head. Jamie might.
Hey guys, here's a question for you. What would happen then if I went to my employees and said, change your withholdings for the next 8 weeks and take out less?
They should take the minimum possible. Yes, because I know, for example, one of our companies, one of the guys over withholds because he wants to handle the distributions, wants to cover the distributions from his, it's an S corp. And the first thing we said is, no, just the least amount of withholding possible because it's going to impact your forgiveness amount.
Okay.
All right. So the story continues. Now we're looking at a non-payroll forgivable costs, rents. We can include those. Mortgage interest. Remember, it's the interest, or it looks like personal property loans if they're secured by the personal property, but only the interest. Utilities. What's in utilities? Your gas bill, your electric bill, your water bill, your transportation, your phone, and your internet. In our example, we're saying there was $8,000 of rent, $2,100 of utilities. So they spent a total of $10,100. However, don't forget the non-payroll forgivable costs cannot be more than 25% of the total forgivable amounts. We use our little quick tool. We take 28.6, we divide it by 3, 9,500. The most we can take is 9,500, even though we spent 10.1. So we throw 9,500 over here. The total amount of forgivable costs is the 28.6 plus the 9,500. We're at 38,100. Now we go to our forgiveness percentage. Remember, we calculated that. Yep.
Sorry, okay, keep jumping in. When I wrote one of my Forbes articles on the PPP, I had about 1 million questions on transportation. Can you go back a slide for a sec? We have a question right now on that too, and it's a question. Dawn's asking a question that everybody has. What is transport? Is it mileage? Is it fuel? Is it what is it? Because I mean, I've had that question from companies that did landscaping, and it goes, "Are it all my trucks?" You know, or what is it? So what do we know, and what do we think it is? Or Mike and Bob both, I guess.
Well, actually, I'd have Jamie chime in too. I've seen nothing. I've seen no explanation of what's included in transportation. Mike, have you seen anything?
I have not. And I actually have spent a career in transportation. I spent half of my career in transportation, and yet I haven't seen anything published on what it means.
Yeah. I had given my opinion, which is worth about 0. About the same as a COVID cocktail.
On a good day?
On a good day. But my opinion to the people I had talked to was if it's transportation within the confines of the regular course of business and not cost of goods sold, then it would probably constitute transportation. If it was cost of goods sold, if you're a trucking company, you can't use your trucks for the trucking company. But if you're driving your if your employees are delivering, to a client or to a customer, part of the ordinary course of business, it seems like it would be part of that. But I would say, run it up to the 25% and let's see.
Yeah, I would hope you wouldn't. Many of my clients, I'm hoping, won't need that one. The inference is it's some sort of a utility.
Yeah.
Yes.
So I would hope that whoever you ultimately think you might be able to get into that slot is regulated by some utility organization, a DOL or something.
Hey guys, I think this is Jamie. I think that they defined or gave an example of transportation cost to the self-employed FAQ as an example, and I'll try to find the wording, but I think that they said fuel for business vehicles.
That'd be helpful.
It was defined in the FAQ as an example for the self-employed, and so I'm assuming that they're going to. Now again, that was not the revised version that they've cleaned up, and so I'll look for it for you.
Perfect, thank you.
We do have what appears to be a conflict between the AICPA FAQs. The FAQ from the Treasury is FAQ 16. So I'll let everybody interpret that their way, but that's the one I'm looking at, and I think Bob, you mentioned that, and Mike, you mentioned that too.
Yeah, I guess, Leon, my interpretation on that is that it's without regard to the payroll cost. I think that there was a confusion early on that it was supposed to be net payroll, and it's been cleared up that it's gross payroll without regard to any any of the withholding taxes. And if you look at the law, Section 102 and 10, in Section 106 under forgiveness, they define payroll costs as the same thing in 1102, which was used for the loan calculation. So I'm assuming that they're going to stay consistent with what you borrowed is what you're going to be eligible for forgiveness. But I do believe this is going to need to be cleared up in the final forgiveness. You know, we're going to get an FAQ on the forgiveness.
Yeah, because Treasury FAQ looks like it's in conflict with that statement.
Yeah.
Yes.
Do you agree with that? Yeah. So
Yeah, they're in complete. That's why I'm throwing it in there as a reduction. And if I'm wrong, great. We don't have the reduction.
let's
And
hit
that's
on
what I'm
rental. If like a lot of places, let's suppose I'm a CPA firm and I rent a building I own. Self-rental is still rent, right?
Correct.
That seems to be allowed. I've not seen
Yeah.
anything blocking that. So
And it would be my normal rent. I can't just jack my rent up because I want to get a bigger forgiveness.
right now, there's an important thing on the rental stuff for your documentation. A lot of people, they say, "Oh yeah, I've got a lease with myself. It's outside of my corporation. I say my first question is, well, can I see your lease? Well, I don't have one. Well, that's going to be a problem because it has to be enforced as of February 15, 2020. So if you don't have a written lease, it's not going to be forgiven. So
And it's affiliated
you gotta
group
get
too,
your
right? If you're
documentation
renting to yourself, aren't you an
in place.
affiliated group?
The affiliated group is only for purposes of the head count. It's not for purposes of this.
Okay.
Yeah.
So what if I pay rent to a control group? What if I pay a rent to somebody else under common control with me?
It shouldn't make any difference as far as I can tell. And, Mike or Jamie, do you think I'm wrong on that one? I think you're fine with that.
I'm
The
reading it.
affiliated group. that's for
But
the
you
head
do
count.
need to have I think the only way you can prove it is if you have you would need a lease signed on
You need a
215.
lease. Yeah. You got to have a lease.
Agreed.
So,
Someone asked, is the lease due for renewal during an 8-week period still countable as long as it was originally in effect in 215? I think Mike,
Yeah.
following the rule of what's paid, yeah, I think the answer would be yes.
yeah, I mean, there's nothing on it, but if I had a lease that suddenly was in effect right now and I got my PPP loan tomorrow and it's due for renewal on June 1st, I'd say, sure, it's just a normal course of business.
Regarding that, the lease in the controlled group, all it's really being used for is to determine that you're an SBA entity or qualifies under an SBA entity. It doesn't have anything to do with the calculations. That's my understanding of it. So gross receipts is always an issue for gross receipts and head count. So just make sure you're eligible. That's how I had interpreted it.
I agree with you. Yeah.
Yeah.
How about a Schedule C? What if somebody's on a Schedule C? Obviously you don't really have withholding on a Schedule C. What is it? So what would count on a Schedule C forgiveness, guys?
That's easy, actually. It's line 31.
Yeah.
It's line 31 divided by 52 times 8.
Yeah, but I think you get to pick up actual payroll as well.
Plus any right. So it's got to be contained within the document of the Schedule C is what you get.
Okay. So you're just running it backwards off the Schedule C. So there is no income tax withholding or payroll tax reductions for Schedule C.
Right.
Yeah. There was something on the payroll tax. I got to remember that.
I remember something on SC tax, but I don't remember. It's not.
Yeah. And I don't remember the SC tax. There was a twist on that, but I don't remember what the details were. So. Okay. Should we continue on this exciting saga?
Sure. I need another cocktail now. So.
Well, you should. You probably
Right.
intravenous would be the best. Okay. So we've got just remember we had a 96%. So if we go through this, we've got a 38.1, 96%. We're at 36,576 is the actual loan forgiveness. So when you think about it, you say we spent 48,600 in payroll costs and non-payroll costs. We have unforgiven of 13,424, but we've got 1,400 of cash left. We've only spent 48,600. So we really are out of pocket for $12,000 and we spent 48 grand. So even in this scenario, assuming that they say you cannot subtract or you have to subtract off your employees' withholding portions, we'd still have a 4-to-1 return. It's just not a bad deal. Required documentation. This is the next be low, and this is where we should be very helpful to our clients. Payroll expenses, put it this way, you have to have all your FTE calculations and you better have those documented. Your base period, your covered period, and Jamie and I have been going through, do you really need them for February 15th and June 30th? It gets really convoluted. Possibly, I wouldn't worry about those. We got to wait for some clarification on the rules. Any employee layoffs or pay cuts and rehires or restorations, keep all the details. What dates they occurred, what dates they were rehired or restored. Payroll tax filings, you're going to have to submit 941s and probably 1028s. And payroll processors, they're going to ask you for, as part of this, just your payroll registers. I know that QuickBooks, Gusto, and a bunch of the others, ADP, et cetera, they're working with the SBA to develop a whole loan forgiveness package. And if that gets approved by the SBA, you'll actually be able to use your QuickBooks or your Gusto or ADP reports. And that will be help you to generate your FTEs, your layoff reports, and obviously you'll already have your filings. So that's out there. The other thing for your non-payroll expenses, you're going to need to verify any payments. Cancel checks, bank statements, you're going to need to show that it was paid in the 8-week period. You're going to need to have copies of invoices, utility bills, loan statements, and copies of your leases and any service or loan agreements. And they've got to be dated prior to February 15, 2020. And though this is probably gross overkill, but I just love killing the gross, I would have a weekly tracker. I would just keep a little spreadsheet that says, here's the costs we incurred that we think are being forgiven, and here's when they got paid. Just remember this, the SBA has been real clear. If you don't give supporting documentation, they're not going to be forgiven. Also keep this in mind. The review of adequate documentation is going to be in the purview of your bank, which means it will not be consistent. Bank one could be just Attila the Hun, and bank two could be, well, sounds good enough to me. So we're going to find a lot of inconsistencies.
Hey, Bob, real quick, I just wanted to let you know I found the section in the self-employed.
Yes.
It's on page 3 at the bottom, second column for those that want to look, but it says a couple of things it said here, which I heard something different on Treasury. It says business rent. So this is under how the loans will be forgiven, and then they start listing it out, and they say business rent payments, in parentheses, they put e.g. the warehouse where you store business equipment,
Right.
or the vehicle you use to perform your business. And then it says, and business utility payments, e.g. the cost of electricity in the warehouse you rent or the gas you use driving your business vehicle. So I don't know if gas is going to be counted for equipment, but I have a feeling if you've got a landscape company, I would be taking it. That would be my opinion, is that it's still fuel utilities used in equipment that you're using for your business.
Yeah, that makes sense.
Makes a lot of sense.
It's going to be interesting. I think it'll be kind of an academic to a certain degree, because when you get done with your payroll, you know, it's going to be a third of your payroll in total. And for a lot of people are going to say, well, I've got enough other costs with rent and things that there's not going to be much left over.
Yeah, that's the way I feel too.
Great.
Yeah.
Hey, Gary, I got a question for you. Going through this whole PPP process and this loan forgiveness process, does it make sense to dovetail this after the 8-week period? Should we be dovetailing our cash flows? I mean, don't you think this isn't going to be over in 8 weeks? What do we do in that case?
You know, this is a real survival period for middle market companies and smaller companies. I think the right strategy is to take advantage of every conceivable, possible, allowed tax incentive that's out there. You know, I've been having discussions with some very top-notch firms that specialize in R&D tax credits. There are only 20% of the businesses out there that are taking full advantage of the R&D tax credit. If you are, you know, resolving a technical uncertainty, for example, there are a lot of activities that could qualify for the R&D tax credit, so there are firms that specialize in it, and I would not take that off the table. It might cost some money up front to revise some tax returns, but the amount of money that could be saved is very significant and worth doing. Likewise for doing cost segregation studies on your real estate improvements. If you're not taking advantage of accelerated depreciation on 5-year and properties or the middle range, which what I think is 15-year, then you're leaving money on the table. I think at this point, survival is good for you. It's good. It's what Congress intends. It's good for the country. Why leave it sitting there?
Hey, Mike and Bob, and actually Jamie too. I'm getting a lot of interesting feedback from people looking at questions 31 and 39 on the FAQs about how they suddenly changed the rules on whether you need the money or not. It started out that if you just used it for your payroll, you could use it for payroll. Suddenly, if you're the LA Lakers or if you're Steak Shack, they gave the money back and they blew up in their face. Worst public relations move in history. And I've seen large law firms taking this and CPA firms taking this and a whole bunch of people taking this. And all of a sudden they said, well, you have to demonstrate you didn't have any other sources of income. Did they suddenly change the rules on this? And I've heard some things from some big law firms. I've been talking to some pretty big law firms about what to do. A lot of folks are recommending that you create some kind of a written paper trail or documentation about the fact that you needed the loan. What's your guys' impression on that? Questions.
Well, let me add one FAQ in there that just came out. I think it was last night, 43.
Yeah.
Which is extended the date to revisit that question.
Yeah, right, till the 14th.
To the 14th,
right? Yeah.
Because initially, I think everybody has really struggled with that, with the deadline being the 7th.
Yes. So what do you guys weigh in on? I've been advising clients that document to your board of directors, document to in your minutes, your corporate minutes or your business minutes that you needed the loan and the reasons why you needed it. You'll have 8 weeks to figure out whether you want to pay the loan back if you decide not to go for forgiveness. I think if you paid it back at the end of 8 weeks, no harm, no foul. You have probably another 60 days beyond that. I'm just curious what the rest of my folks think. As soon as I started reading that, I went, wait a minute, you guys changed the rules in the middle of the game. But am I reading that wrong or not?
I don't really think they changed the rules. I think they just saw people abusing them. Because if you look at the examples, they talk about, oh, if you're a publicly traded company and you've got access to these types of capitals. And if you look at what Mnuchin said, they're looking at the loans in excess of $2 million. That's where the audit's going to be focusing on. I think if you're a smaller company, and if you've got a reasonable need for it, it doesn't mean you have to drain all of your current resources. I've got one company right now where they called me up and said, we do healthcare. I can mortgage my house. I've got enough money sitting in the bank right now that I can hold out for 8 weeks should I return the funds. And I was like, no, there's no requirement that you mortgage the house and you put your own personal funds back in. If you've got 8 weeks worth of working capital and that's it, do you think your business is come back? And he says, well, we're at 40% of the sales we were, so we're still just a little under break even, better than I'd hoped. But it's like, that's a reasonable thing to say, no, we need the funds. If you find out in a month that you don't need the rest of them, well, like you said, Leon, bank the rest and then just refund it. Say, we aren't going to use it. So we got a $200,000 PPP loan. We spent 50 of it. We're going to refund the other 150 because we realized we didn't need it. We followed the intent. Always follow the intent. Correct. You thought you had it and a need for it in good faith. When you found out you didn't need it, you stopped using it and you returned it. There's no prepayment penalty. Right. So, it's not a harm if you.
Well, yeah,
go ahead.
It also says that it's my interpretation as well as it says to the unforeseeable future, that you've got unknown economic uncertainty and especially if you live in Michigan, we don't know what this governor's going to do again, and if there's going to be any economic uncertainty. And Bob, I agree with you. I mean, I've got several orthodontist clients that have taken it, but they've got personal money. But are they required? Are they required to put personal money back into a corporation? And so I'm saying no, you don't, and you've been closed for 4 weeks, and even maybe another 3 to 4 before you go back. So yeah. I've kind of said just, so some of it might be like you said, Leon, is documenting and maybe doing some cash flow forecasting to show. But I think that it's going to be a PR nightmare if Treasury comes after the sub $100,000 group or even the sub $500,000 group under this, because of the fact that that's what defines small business. And they start going after them, and the news gets hold of that. I think it's just going to be, they're just going to burn them at the stake.
Yeah.
But
And I
Leon,
would-
to answer your question, I do think it changed the standard to the extent it's that was originally published. So we're actually having this conversation about documenting that wasn't required in the original
Right.
application. There was no original documentation request asking you to evaluate your liquidity, and so
well, it was in the certification. You had to certify in the loan application. That
yeah, but
language
the loan, if you look at question 31, they added some provisions that weren't in the loan application.
Right.
So
Yeah.
you may believe they were always there, but I think others think that the initial loan application inferred that everyone was affected by the coronavirus. So
See, I never did, because I had two clients that when we looked at it, we did all the calculations, and then the conclusions, we concluded that no, we don't qualify, because we looked at it and said our business has not been impacted. We don't think that it's going to be in the foreseeable future. Therefore, we thought not only would it be inappropriate for these clients to take it, it would also be, you couldn't make the certification. So they said, no, we're not doing it. And I applauded them. So,
which I think I agree with you. I'm just observing that 31 did add a little more than was originally.
It did.
I'm advising people to document. So I'm advising, get a documentation, take a look at it, keep your loan in most cases, unless you're making masks, keep your loan. At the end of 8 weeks, either if you decided that everything's all over, Dr. Fauci comes out and tells us peppermint lifesavers, cure COVID, and we're all great, then you could pay the loan back if that's the case.
Right.
But I would suggest, I just think documenting is a good example. There's four lawyers on the line. Always err on the side of being a little bit overprotective, I would say. Hey, Mike, I got a question for you, and I'm going to start wrapping up in here in a little bit. So any more questions, please do that. Mike, talk to us about this the tax-free nature of this thing. It was supposed to be tax-free, and then you can't deduct the expenses you have. And, first and foremost, is that part of the intent of the law? Bob, you're keen on the intent. You've divined somehow what they were thinking in Washington when they weren't on some
So
kind
the intent of the law is kind of a mystery. Frankly, when I saw it written in the law, I did think it was a windfall. I instantly looked at that and said, this really isn't 315 million or 350 million. It's 350 million plus at least 21% the corporate rate, if not more, an individual rate. If you're carrying especially if you carry it back, it could be a lot. So the way I read the rule, the way I read Congress, the act is it was pretty explicit. The proceeds were not to be included in income. Now, notice 2032 comes out, and the government takes the position, well, but that may be, but then you don't get to deduct the expenses.
Right.
And the problem I have with that is it defeats the clear language. It in effect guts the language in the statute. So in order for 2032 to be correct, you have to believe that Congress understood that it had no impact, and that surprises me.
I was on a webinar today with a couple senators, and that was one of the questions that we brought up, and they discussed, and they said, no, they clearly did not expect it to be double dipped. So they did not expect that if you got PPP loans and those dollars were forgiven, that you could also deduct it. And that matches what they said in the IRS.
Oh, it certainly, and I've heard from other congressmen that they did. So the challenge with this one is there's not a lot of legislative history when you have something happening as quickly as this happened, Leon.
5 days, right.
So I'm not sure who's going to be able to determine why the Congress chose, but they chose it twice. So this is one of the things that troubles me on the whole act, is they passed it once and then went back and did it again without fixing it.
Well, and also, Bob can answer this. The EIDL forgiveness is tax-free, and there's no offsetting 265 on that, right? There's no offset on an EIDL. If I get a $10,000 forgivable grant, I can deduct any expense I used it for, correct?
You can, because don't forget that the EIG grant portion of it, that's a reduction of your PPP loan forgiveness. So if I get a $10,000 EIG grant, then at that point in time, when I had a $40,000 PPP loan forgiveness, that 40 just went to 30. So I can't double dip that.
But
So
correct me if I'm wrong. Wouldn't I then be better off if I was relatively small to go get an EEIG and then not take as much of a PPP, because the forgiveness on the EEIG would be offset by my expenses and the PPP would not. It's crazy. This is,
it could be. Now keep
Mike's
in mind,
laughing, which is I'd either laugh or cry because of this.
Exactly.
but you might actually, depending upon the scenario, you might be better off taking the retention credit, because the retention credit, clearly that credit you can take, you get, and you can deduct the amounts that you spent for the payroll. So, you know, you got to play all the games. I would say, you know, you're getting into academic minutia. Basically, my feelings would be the Paycheck Protection Program, if it's forgiven, don't deduct it. We should assume that unless
Until we hear otherwise.
clear on it.
Well, you got a notice out there that says you can't. So
Right.
You can't
Yeah.
right now until you hear otherwise.
Yeah.
Hey guys,
Now,
I'm gonna wrap us up. I need to wrap us up because we, believe it or not, went through 58 straight minutes of talking about esoteric tax law without putting, well, we might have put 75 people to sleep, but we kept all of us awake. We've got another session going on tomorrow. I'm going to ask Jim Jagger from the MICPA to come back. I want to thank all our panelists. And Jamie LaPiccolo, thanks so much for being on. I think tomorrow we'll pick up a little bit of this, but we're also going to cover some other. Jim, would you mind just telling our audience what we're going to do tomorrow night, same time, and bring cocktails?
Thank you, Leon. Tomorrow I have a couple housekeeping items that I want to get to as well. Tomorrow night, Leon is going to lead the conversation, and then we might not all get COVID, but we're all going to pay for it. I think that's going to be a very interesting topic. Leon published a blog on Forbes.com that you can search for. That you might want to look at ahead of the conversation, give you a little taste for it. We're going to have next week session 3 in this. Gary will be leading kind of constraint theory, and then Mike will wrap up the next Thursday. You can find links to register for all of these, and I would suggest maybe doing it in advance so you can pop right into the meeting. You don't have to register and then try to get in at 5 o'clock. They're all going to be at 5 o'clock. They're all available on the MICPA website. There's a special page dedicated for this. You can find it by going to our resources, clicking on the news, and then linking through when you see the icon for this. We're also posting social media. So the path that you got here tonight is kind of the same way, but each one has its own registration link. So you'll have to re-register for each of these programs. We're also providing roundtables for members every Thursday at noon. You can find those on our COVID resources page at micpa.org. And I would say that for all the MICPA members and the CPAs in the audience this evening, the association is working very hard to put you out in front of the public and connect you with businesses. And most of our social media posts right now are all about the value of the CPA in the effort for recovery. So I would ask you and encourage you to find us on social media, LinkedIn, Twitter, Facebook, and share our posts to your audience. It's going to help spread the word. So thank you very much for joining us. Thank you to our panel. Thank you for Jamie LaPiccolo for jumping in impromptu. And everybody have a good evening. Stay safe and 6 feet apart. Thank you.
Thanks, everybody.
Good evening.
Thank you.
Good evening, everyone. Bye-bye.
Good night.